Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, May 22nd, 5:45 p.m. Eastern Time, coming to you from rainy St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Market state, we're in a large cap uptrend, some improvement with mid caps and small caps recently, which coincides with weakness in the Dow. So this is really being caused by weakness in some of the more, ironically, the defensive sectors, particularly staples. Now, you would think with a recession coming that the stocks that would hold up the best would be the stocks that represent products that people can't be without. And, you're thinking Procter and Gamble, et cetera. But these have been really started being weak at the end of last week when money started flowing into growth, and that absolutely continued today. XLP down 1.5%. We'll take a look at the rotation when we get to the charts. Over here on the trend gauge, market leaders, we upgraded last week to uptrend short term, also uptrend without the Dow. That continues, as I said, to be weak, and it's really being dragged down by a couple of high-priced stocks because it is a price-weighted index. Medium term, 50-day moving average really showing some improvement. We've got neutral here, but the green sub arrow as mid caps and small caps are battling to get above and stay above the 50-day moving average. Long term, some improvement also. Mid caps fighting with the 200-day moving average, small caps improving. Large cap indexes continue to be above the medium term 50-day and the long term 200-day. But again, Dow continues to weaken. So what happened today? Early strength opened about flat, but up strongly in the first 45 minutes. Leaders really cranking, and then a fake news headline hit and got some traction. Somebody posted some pictures of explosions near the Pentagon. I saw it reported on at least one news site, and it's very clear on the chart. You'll see when we go to the 5-minute where we faded. That was debunked within 15 minutes. And then we started chopping higher, went into a 4-hour base, tried to break out late in the day, but faded. I have headlines here because there were a lot of conflicting headlines. Actually, not conflicting. There were several negative headlines coming out of the debt ceiling negotiations, with both sides doing their typical posturing, and that ended up with the market closing weak. Here are the final numbers on the day. RG7 growth outperformed again, up 1.3%, led by ARK-K, up 4.8%. Several of the top 10 in there really cranking, including Tesla. S&P 500, a disappointing, basically flat, up 0.02%. NASDAQ 100 up 0.34. Buoyed by semiconductors, which started out with a gap down, but finished up 0.35%. The SOX did anyway. SMH finished slightly red. Dow was the weakest all day, down 0.4. Mid caps up 0.5%. Russell 2000 up 1.22, continuing to show some relative strength that started last week. And the KRE continues to gain strength, up 3%, 3.2% today. So the market trying to put the regional bank crisis in the rearview mirror. Global 60/40 up 0.08%. Bonds down again today. I think this is like the 7th or 8th straight day that bond prices were down, meaning yields higher. In-house GROTECTION, we were cranking early, and then some of our positions just started bleeding into as the day went along. ELF particularly disappointing, and some of the retail related names started strong and faded. We'll hit the tail of the tape and then charts of interest. Let's get right into it. S&P 500, our day count is 2 up and 2 consolidating. You can see this very clearly on a 30-minute chart. Here is day 1 up, breakout out of the range above 4150. Day 2 continuing higher, and now just consolidating near the top of this range. So we're holding above this 4180 level. That's where we've held on pullbacks each of the last 2 days. That's near the top of the prior peak from the beginning of May. But anytime we get above 4200, we've been running into sellers, plain and simple, whether it's news related or just people taking profits. We'll go to a 5-minute chart on the S&P here, and you can see the early strength. Couldn't get above Friday's high, and here was the big sell-off on the news. Started here, gained traction, and then a quick shakeout down to 4180, higher, another test of that. Here's the sideways consolidation. That's really, it's not a base, it's more of a chop because there were some uh, severe spikes higher and lower in here. For example, 115, we tried another sell-off. And then here's the breakout above 4,200, but just up to 4,207, and then some headlines from the debt crisis hit, and we bled into the closing 4293, 1 point above where we closed on Friday and exactly where we opened the day, 4192, 4193. So there you can see why our day count is up to C2, 2 days up, 2 days of consolidation. That's okay. It's not a negative. It's a disappointment, but not a negative. So this 4195 from back here in February, the prior high, we're battling that. Seem to be holding the 4186. We don't want to break below 4180. That's the lowest we'd want to go before any today's lows and Friday's low, before any negativity might creep in, and then that would still be above the 80 MA and the 21 EMA. Note the 21 and the 50 have a pretty good slope higher lately. These shakeout days from back in March are falling off the 50-day moving average, and the 21 strength here and strength here, uh, gaining about 6-7 points a day on both of them. The good news with that is if you're in a bullish uptrend, when you pull back to strongly uptrending moving averages, the tendency is to bounce off of those and continue the run higher. So this is definitely something that we're happy to see. We've been a victim of flattish indexes for quite a while, and well, flattish is better than the downtrending indexes that we saw for most of last year. But we'll take the strength. Leaders, the breadth still isn't there, but we're improving with the small caps improving. Certainly a handful of stocks still leading, but you really only need a handful of stocks to make progress. I've very easily got 60 leading stocks on the list. How many do you really need? So there's the S&P 500. Let's go to the NASDAQ 100. Open flat, ended up positive on the day. You can see the relative strength as this thing continues to be the absolute leader. Let's go to Dow, which currently is the absolute laggard, holding the 50-day moving average below the declining 21, relative strength continuing to make new lows. This is really, really bad relative strength line. Mid caps, let's go to MDY, the mid cap ETF, and you can see it's been really up to C2 also, 2 days up, 2 days consolidating. Tried to break above the 200-day last week, couldn't quite do it, sitting right below the 200-day. The 50 and the 21 are overlapped, so, and the 8 also, so that's kind of trying to form a floor to bounce off of and make some higher highs. We would really like to see this, and it's only a little more than 2%, break above this 460 level, which served as resistance back in late March and April. Let's go to IWM. Note here the relative strength line making like 2 steps up, 1 step back over the last 6 sessions. That's a good sign. Clearly above the 50 and the 21. Now you see the 21 crossing up the 50-day moving average, which has stopped declining and is flattening out. Overhead at 180, a little over above 180. We've got the 200-day moving average, but hey, it's a start. It's the most progress that we've seen in small caps in over a month, and we'd certainly like to see it continue. So you can see this 180 area, very similar to what I just mentioned on the mid caps. This 180 level and the 200-day moving average. That's going to be a big level to get through. And if we can get through there and carry the market higher, that would be good for bulls without a question. Let's flip to the VIX. How did that do today? Got above. With the spike was due to that. You can look in the 5-minute chart here. That fake news headline that came out. So the VIX falsely spiked above the 21 now. Below the declining 21-day moving average is a good spot for the VIX. The S&P 500 average true range is down to 1% daily. People are saying the VIX is broken. It's not broken. It reflects the volatility of the S&P 500, which during the bear market, on a daily basis, the S&P was moving 2.5% a day. Now it's calmed down. It's down to 1% a day. That's a significant move down in volatility as far as the overall market is concerned. Let's go to the dollar. Dollar continuing its strength that started last week, pull back on Friday, inside day today. How did that impact gold, silver, and gold and silver stocks with the dollar being up? Does the inverse correlation stand? It did today. Just the opposite you're seeing here in precious metals, which was the move down, 1-day reprieve as the dollar took a break, inside day, but a close down 0.23%. Gold stocks, GDX, inside day down 0.9%. Silver down 0.87. So continuing the inverse correlation with the dollar, and that inverse correlation has really not been as strong with the overall market as it had been uh, recently. It's keeping the correlation on an inverse perspective on the precious metal stocks, but not so much with the indexes. What's next? How about Bitcoin BITO? Flat on the day, 2 very tight days for Bitcoin. Let's flip the bonds now. Bonds continuing 1, 2, 3, 4, 5, 6, 7 days lower now on the TLT, also on the BND. That means rates continuing to go higher. There's TLT. Here's the broad index BND, 7 days down there. Also, let's go to TYX. This is the long bond yield, continues higher for, yes, 7 days, breaking out. It's got some resistance here. And remember this abandoned baby top all the way back at the beginning of March. We're coming up to retest that again. A lot of resistance around this 40 level, which is 4% on the long bond. TYX is the ticker here in MarketSmith. Let's go to TNX, the 10-year bond, continuing higher. Also, not anywhere near the yields from back in March, still down around 371. So quite a bit to go. And basically that means the long bond, the 30-year outperforming to the upside, the 10-year, which kind of it's normally expected to do. You're supposed to have higher interest rates on the longer end. So those are bonds. Let's see, is that everything? Yes, that is everything that I want to cover on our inter-asset correlations. Let's go to the tail of the tape now. You can pause this. I'll hit the highlights. Stochastics are positive, with the exception of the dollar. They're positive on the NASDAQ, the RG7, and the 5 major indexes, although the Dow did tick down today on its stochastic. VIX at 17, fear and greed at 70. This is getting a little on the high side. This is the highest it's been in a while. Here's the news, the fake Pentagon explosion and debt ceiling uncertainty up to C2 on the day count, 4th day above the 8 and the 21. A good trend gets, I've been tracking this for a while, gets around 20 days above the 21-day moving average. That's really when you want to focus getting in the strongest leaders, as long as the market is trending above its short-term 21-day moving average. And our expectations therefore remain positive as long as we're above there on the NASDAQ and the S&P, which we are. S&P failed again, getting back above this 4190 to 4199 area. 4190 is 20% off the low. 4199 is a key fib level, and as I said, we've poked above there several times in the last 3 days, but can't stay above it. But we're just consolidating a strong 2-day up move. It's really normal reaction. Here are the ranges and the closing percentages on the day. Sector strong. KRE again, TAN, cloud stocks, and biotech. Semiconductors, as I said, started weak. On Micron news, Micron, China banned some of their chips for security fears, and that trickled over to the broad semiconductor indexes. But you can see all MU did is pull back to the 65-ish area and bounce. That's a good reaction from Micron. You can see the volume was heavy, but closing at the top of the range. The SOX also, as I said, gapped down, but finished at the top of its range, didn't even come near the ADMA, as this was just phenomenal strength shown in semiconductors last week. Let's see on the downside, XLB and XLP. Now I mentioned, I want to show this XLP. This is consumer staples, and it really started going lower and lagging last week. It was the worst performing sector in the S&P, and it added to it today, down 1.51%. We've had Mondelez M, DLZ representing staples in the 21 over 21, and it gapped up on earnings and then held for a while, but now finally breaking down and broke below the 21 today. That's a consumer staple stock, and Procter and Gamble, really the best known staple stock, gapped up on earnings too, but has completely given that up and broke the 21-day last week and the 50 today. So the conventional wisdom with a recession to pile into staples is absolutely positively not playing out over the last week. Uh, so what did we do on the portfolio today? We added to Celsius on early strength, which faded. We bought Shopify. First, let's take a look at these charts. Here's Celsius on a 5-minute. You can see the early strength. This coincided with that buy signal I've been using coming up off of the 60-minute stochastic, but it faded along with a bunch of other retail stocks during the day. This 130 level should provide support. We want to reset here and look for another slingshot off that 60 stochastic. But then again, they don't always work. This was the same setup with GDX that failed too. But if it doesn't work, you know very quickly after you get in that it's not going to work. So there's Celsius. Shopify started out really strong today. Let's go to a 5-minute on this. You can see, and it's bouncing right off. Here's the stochastic. It started the move early in the day, bounced right off there. That same setup. You can note the pullback into the ADMA in this 60 area. Strong move up off of there. So we added that today. The other one, and these two buys today are both stocks in the 21 over 21 list. We added DT on Friday on this nice earnings shakeout, breakout. Great volume, really good volume here. Nice fundamentals, tight inside day after the move out of the base, and another tight day today. And we took 2% buy, so we've got 4% in this, very similar to Shopify. On the other hand, I said retail was fading, and this really had faded since some bad retail numbers came out last week. ELF closed the week on the 21, failed but reclaimed the 21 a couple times over the last 2 weeks. Really broke it today, sitting on the 50-day moving average. We've got earnings in 2 days. We sold half of our position on this today, down about 4.5%. We still have 1.5% left. We'll see if it can bounce off the 50-day, and then we'll make the decision into earnings, but most likely we won't hold it into earnings. Let's see. Uber started strong, faded today. NVIDIA and AMD started weak and gathered strength. Chipotle, another one, just really too far, too fast on this. I said retail failed. This had a nice 4-day up move, trying to make it 5 with a gap up this morning, but reversed. Along with several of the retail stocks. So several things that we own that showed recent strength, just taking a little bit of a breather today. We'll focus on these names when I go through the charts. The changes that we made upped our beta slightly. Bottom line, early strength fades on debt ceiling uncertainty, second day of a consolidation after a two-day up move, and small caps starting to show some strength. And speaking of strength, ARK-K, making a nice break out of this recent consolidation and this stacked moving averages here. Uh, Good stuff here, above average volume. A pullback to 40 would be very viable. For that additional strength with DraftKings, which we got stopped out of last week after the 6 days down after its earnings gap up. Just really no follow-up buyers, but the volume dried up also, and then it bounced very nicely. Let's go to that 60-minute chart and I'll talk about that. Here's the initial bounce, and then it failed. And when it failed, this is where we stopped out, but it was a fake out, and it bounced stronger the next couple days. We got an upgrade today, finished way off of its highs as the market pulled back into the close. But look at the volume compared to the volume on the pullback day. So this is when we got shaken out of. We'll look to reassess and possibly get back in. Shakeouts happen all the time. It's just part of the process. And one of the three that I was focused on coming in today was Tesla, as I like the volume and the action since their shareholder meeting last Tuesday. And nice day today, up 5% on average volume, finally starting to show some relative strength. Right overhead is the 200-day moving average. Look for it to maybe come into this 200 level, which is also the 200-day moving average. Pause for a little bit, maybe put in a handle, and that'll convert this flat base into a cup and handle, which would also be a stage one because it undercut this prior stage one cup and handle that happened back in March. So Tesla definitely setting up nicely. Along with XLP being weak, low volatility stocks, which again are normally supposed to be recession proof, but SPLV has fallen apart along over the past week. Really weak on a relative basis. This also happened at the end of December and into January. Look at the relative strength line. The price action itself didn't look too bad, but on a relative basis, it was just absolutely getting hammered. That's happening again today. And its counterpart is SPHB, high beta stocks. We're strongly considering adding this to the G7 to make it the G8, as it definitely signals when risk on and growth stocks are outperforming. And that's the purpose of that composite that we calculate every day. You can see it very strong in January when growth stocks had their move off the bottom, and then weakness recently since then, and that corresponds with a choppy market, difficult to make progress. But last Monday, the relative strength on this turned to the upside, and it's big time been performing. SPLV, the low volatility counterpart. These are two tickers that are up on my screen every day, and it gives me a feel for where money's flowing, and probably will end up adding it to the G7, and now we'll be up to the G8, and I don't think we'll go higher than that, but you never know. And that's going to wrap it on the day. So why do we do what we do here at Revere? The purpose is to keep our clients out of severe bear markets. All of these bear markets occur under the 200-day moving average. When you're in a bull market, the average pullback to the 200-day is 11%. Very often that's as far as you go, and you bounce off there and regain the uptrend. If you break the 200, you're at risk for these a full a 20% bear market, or something that's even worse. We got 35% in COVID in 5 weeks. We got 27.5% last year from January to October. The inflation bear market, we're back above the 200-day moving average, and obviously that's why we've been taking positions. And then when we get above shorter term moving averages, we add. And markets, it really in the best shape that it's been, in my opinion, for the most of the year. Outside of the strong move up in January, a lot of that was off of oversold, but we've got some quality stocks on our list. And if you're interested in an approach like this, reach out to me, Don at RevereAsset.com, or my partner, Dan Stewart, Dan at RevereAsset.com, or phone 855 Real Wealth. That's 855-732-5932. And with that, I'm going to remind you, it's not how much you make, it's how much you keep in the markets. and we'll wrap up Monday, May 22nd. This is Don Vandenbord with Revere Asset Management, telling it like it is, just the facts here, peddling market facts at Revere 5 times a week, plus a podcast on the weekends. Thanks for listening and have a great day.